I want to bring in Charles Gushee from Auerbach Grayson to give us a little bit more perspective here to join the conversation. Charlie, good to have you with us.
Thanks, man.
What do you think about this debt downgrade? As Julie was just saying, I mean, this was pretty much expected, but doesn't this now cause a lot of money managers rather, to look into their portfolios and say, look, I can no longer legally hold these various debt instruments. My covenants won't allow it. Now I've got to find someone to buy these off my hands, and that somebody is probably the European Central Bank.
The point is the market's actually been complacent. They've killed Greece, but you know the Italian bond was at a 5% yield a week ago. So if you're talking complacency, you know, look at what's happening on Italy today. It's that people are waking up to the scale of the issue. I mean, the refinancing that Italy has to do this year almost equals the total outstanding debt of Greece, and that's just what they have to refi in the next 6 months. So I think portfolio managers have been very complacent. There's a flood of liquidity that's kept them in debt, and they're waking up that the risk is a heck of a lot higher than a 5% pays you for.
Well, it did touch 6% today, and then it came right back down again because there was this speculation about the ECB coming in and buying, as you mentioned, Pimm. I mean, but isn't that just a Band-Aid? Isn't that just a short-term solution?
Absolutely. The problem is that at the end of the day, the ECB is really Merkel and Sarkozy, and these are people who have to run for office. They can't stand up and write a big fat check to other countries. So everything that's done has to look like it's with a gun to their head, and that means it's a torturous, complicated process. And when you say complicated, you usually mean discount the valuation.
All right, well, let's let Charles Gushee of Auerbach Grayson, let's get another perspective. I want to bring in Domenico Lombardi. He's a senior fellow at the Brookings Institution, also former executive board member at the International Monetary Fund and World Bank. Domenico Lombardi, good to have you with us on Bloomberg. You've been listening to the conversation Julie Hyman's been having with Charles Gushee here about the debt downgrade in Ireland. What are the implications for the European Central Bank? I mean, do they have any more money to buy up this debt from private investors?
Look, this is not really, a problem of Ireland. It's not a problem of Greece. It's not even a problem of Italy. It's clearly a systemic crisis of the euro area. The fact that the situation is getting worse in Ireland, is getting worse in Italy, in a way is triggering a shift in the attitude of senior European policymakers. We have already seen that the attitude of German politicians has changed over the latest couple of days. Now they appear to allow the EFSF, the European Rescue Fund, to intervene on the secondary markets to prop up the course of distressed government bond debt. Not only that, they are now trying to lower the premium that distressed economies like Greece, Ireland, and Portugal pay on their EFSF debt. So, but most importantly, the fact that Italy has been dragged into the crisis has added a completely new dimension to this this crisis. Italy, with about $3 trillion of debt in the U.S. outstanding, is a nuclear landmine at the heart of the euro area, which not even France and Germany would be able to manage if it were to explode. And therefore, what this means in terms of policy implications is that we could see some progress over the next few days, perhaps even at the emergency summit that may be convened on Friday, where European leaders will not reach a deal, but may get very close to it. And again, now we are at a point where we are very close to a systemic blow-up of the euro area. German policymakers and politicians have understood that they need to be more proactive, more flexible, because this really goes, beyond what Italian or Irish or Greek policymakers can do.
All right, we're going to continue the conversation. Charles Gushee, this idea that this is a systemic problem in Europe, I mean, that has been around for a while, but the Germans have benefited from the introduction of the euro and the expansion of the Eurozone. Is it likely that they're just going to go quietly into the night and let this disaster continue, or will they finally stump up the money and maybe even just pay all of the debts, buy up the loans of a country like Greece. Why not?
Either way, it's going kicking and screaming. They won't let it go. They won't throw the euro under a truck for the reasons you mentioned. And the euro really is a political structure before it's an economic structure, right? And Germany has benefited. But there's no way they can stand up and eliminate the problem by footing the bill. So I think that you're looking at a long series of workout negotiations that are going to continue through next year and probably the year after.
Julie Hyman, in the reporting that you've done, the bid and the ask spread, I mean, we always talk about what you're willing to buy something for and what you're willing to sell it to someone else for. Have you noticed that there have been widening and that as a result, the market is getting less and less liquid? So it makes it even more difficult for people to buy the insurance that they normally would get to hedge their portfolios of Greek, Irish, Spanish, Portuguese debt.
So typically, of course, you look at the spreads between these various countries we've been talking about and the Bund, the German bonds. And you have seen that widening. In some cases, widening to the biggest it's been in at least a decade. So definitely, you're seeing, you know, these countries get squeezed, obviously, on the one hand. Investors get squeezed on the other hand. Again, there was a little bit of a narrowing from those extraordinarily wide levels today, but you know, something comes out tomorrow and they can go right back to those wide spreads once again.
Domenico Lombardi, speak a little bit more about Italy, the third largest economy in Europe. 120% is the debt to GDP ratio right now. Comments are often made that most of the Italian debt is held domestically. Does that really matter?
Well, of course it does in normal circumstances. Italy's public debt is very high, but it is also well managed. The market for Italian public debt is highly liquid. It really is considered one of the best of its kind. And most of the debt is held by residents. The average maturity is quite long. And therefore, you know, under normal circumstances, there should be really no problem for carrying over. However, this is really a crisis of the euro area, and therefore, you know, it's not that the crisis is going to end up with Greece or with Portugal, but certainly speculation is going to hit Italy and maybe other countries of the euro area. And therefore, this is why it's extremely important that the euro area policymakers all together you know, really support and provide a convincing response to this crisis, something that they have not been doing so far. However, the fact that the crisis has moved from peripheral economies like Greece, for instance, which accounts only for 2% of the euro area GDP, or from Portugal, again, very smaller economies of the euro area, to a more systemic economy of the euro area, is really now you know, putting stronger incentives on the European policymakers, in particular on the German policymakers, to act more decisively and provide a more convincing response. We have already observed signs of this yesterday, and I think over the coming days, the Germans will be more proactive than they have been so far.
Charlie Gushee, I want to get your thoughts, though, on the European Central Bank. They're actually looking to raise interest rates at a time when you even get reports that many of the regional economies of Spain, for example, are saying our budget deficit, it's actually double what we thought it was. Why would you be raising interest rates when your constituents are saying our budget deficits are much higher? It's going to be more expensive.
The ECB targets inflation. They're not targeting a deficit, and they're not targeting GDP. So if you're looking at an inflation number, look at what raw material costs have done, look at what CPI trends are in the big healthy economies in Europe, and they are an early actor, and they don't change their direction nearly as quickly as the Fed does.
Julie Hyman, investors, do you think they're getting nervous if they're holding any European bank debt or indeed the equity of European banks?
Well, they seem to be getting nervous. Right. I mean, whether you look at the equity or the debt, you can also look at the credit default swaps or the insurance against default on many of these banks. And just like you're seeing it for the sovereigns, you're seeing it go through the roof. So the cost of holding the CDSs, the credit default swaps, is getting much higher. And
then there's the question that that'll even pay off, because if you don't get that technical default,
right,
then you don't even get the payoff.
Exactly. And also the one other point I would add is that when the U.S. economy seemed to be chugging along, U.S. investors seem to be shrugging all of this off. Now that there are chinks in the armor here, the market is much more susceptible.
I want to thank you very much. Julie Hyman from Bloomberg News, our markets desk, Charlie Gushee, Auerbach Grayson, and Domenico Lombardi from the Brookings Institute.